Welcome to Driving Alpha, where we feature our friends, the outperforming investors who demonstrate their path to driving alpha or outsized investment returns. We're Alpha Partners, where we partner with 1,000 early-stage venture firms as their opportunity capital to invest in their best companies.
Hi, everyone. My name's Steve Brotman. I'm the moderator for this episode of Driving Alpha. Driving Alpha explores with investors their perspectives, their backstories, and how they generated outsized returns over their past career. Today, I have with me Hans Swildens. He's the CEO and founder of Industry Ventures, a firm he founded in the late 90s in the Russian hills of California. Welcome, Hans.
Thanks, Steve. Nice to be here.
Great. Good to have you as well. And why don't, instead of me mangling your background, why don't you share a little bit about your backstory and how you got to Industry Ventures? And before you do that, share with us a little bit about Industry Ventures. And one of the things that you and I talked about was that you're now the largest backer of emerging managing VCs, correct?
Well, we're one of the biggest. I don't know if we're the largest. You could probably debate that, but we're definitely probably top 3 or 5 in the U.S. for small emerging venture fund managers. And
you just closed your fund, right?
We did, yeah. We just closed almost $1 billion of commitments to focus on that segment of the market. And we're investing in new venture funds. We're investing in existing small venture funds that we've already invested into previously, or that we've made the mistake of not investing in their first fund or second fund and participate in their second or third fund and moving forward. But yeah, we have a portfolio here of over 100 small venture funds in the United States. And so we think we have one of the larger portfolios in the world of small venture funds. Specifically in the US, I think we might have the largest.
That's remarkable. And in total, what's your total AUM today?
It's over $8 billion of commitments, and it's the investors here are all institutional investors, pension funds, endowments, foundations, wealth management teams, and other institutional investors.
Awesome. So it's pretty remarkable. I mean, we met in the mid '90s at business school. Tell our audience a little bit more about how you got to industry in like 3 or 4 minutes, if you can.
Sure. I mean, we had parallel experiences. It was obviously great to know you in business school, and we shared some mutual friends. And I think both of us, after Columbia, went and started companies. And so we came from the entrepreneur side of the market. My brother wrote part of Netscape Navigator and he helped build the interface components for the Unix browsers, because Unix had different basically platforms you had to build to. There was IBM and Sun and DEC and others that all had different different software stacks that you had to build on. And he built the interface components that let the browser run on all those and look the same. And
this is at the beginning of the internet revolution in 1995.
Yeah.
Right.
Yeah, both of us. I mean, I was in business school in 93 to 95. And so, I had a brother living out here in Silicon Valley who was a software developer working on a lot of the new technologies that were being developed. And, when AOL and Netscape and everything came out, he was kind of in the middle of it, living in Mountain View and Palo Alto. And so he was my bridge to the tech market. And when I moved back out to California after business school and worked for a brief stint at Nestle to get me back here. And then I resigned and started a software company with him called Microline Software.
Great. And what happened with Microline?
It was short and sweet. It was super stressful. But I sold the business. I ran the business from an operating perspective, and he was, our CTO and chief developer. And I sold the business about 1.5 years after we started it together, and combined it with another business that was one of the original kind of expert system AI companies, funny enough, that had a software stack. Yeah. for software developers, and the idea was that we had the next gen kind of Java user interface components that let you run apps to the browser, and they had kind of backend servers and a bunch of legacy technology they were porting into Java so that you could build applications, an application that would run through the browser. And we actually took that company public, and then it was acquired by Fair Isaac, and it's still operating inside of Fair Isaac.
So how do you transition into venture? Like, how did that, like with myself, I'd started Ad1, we were venture backed by Venrock. We sold it to Hearst a few years later.
Mm-hmm.
And I made my first, angel investment, and it went to the moon, and went public 18 months later. So I rolled it into a fund, and that's how I got into venture. It was like people were pounding on the table saying, "Hey, I'm going to throw money at you," and I was like, "Oh, sure, I'll do that."
Yeah.
Then the VCs started throwing some money at me. Tim Draper and Steve Jurvetson, about half my capital, about a $15 million starter fund. How did you go from 0 to 1?
I had no one throwing capital at me. It was the reverse.
Well, I exaggerate a little bit.
Yeah. There was
begging on one
money flying everywhere.
What do you mean? Get out of my office! I already said I'd invest $1 million.
So, but anyway, after the first startup with my brother, I helped him start another company, and I was not operationally there, but I wrote an investment into the company and helped raise the seed round. It was called Speed Era Networks, and I had subsequently, after leaving the first company that we sold, I started consulting with other entrepreneurs. And when I wrote a check to help my brother start his company, I was approached by a friend from business school, Norm Villarina. I don't know if you remember Norm, and he said you should really be doing a fund, and we could do angel investing together. He introduced me to Tom Lytle, who was also another entrepreneur, and his family is very entrepreneurial, and started a bunch of payment processing businesses, one of which is the payment processing division of JP Morgan called Payment Tech. And if you looked at my background and Tom's background, it was very complementary. And we started doing angel investing together. But that was in 2000, right when the stock market collapsed. So the original idea behind Industry Ventures was kind of an angel investor focused on infrastructure, B2B software, but the market completely collapsed. And in that distressed moment, we had to figure out, do we keep doing this? Because there was no liquidity and lots of
you'd raised an early stage fund?
We raised a small pool of capital from other entrepreneurs like ourselves, and we wrote a check into the fund ourselves.
Now, how big was that at that time?
We ended up having, in terms of capital available to invest, about 20 million. And so similar to your fund.
Yeah.
But the stock market collapsed. So everyone, including ourselves, looked at what was going on and said, it's probably a bad idea to continue investing into seed stage companies, because there's going to be, we were going through so much turmoil. And at that point, Norm decided to leave, and Tom and I were sitting together at one of our LPs' offices. Bill Melton was his name. He founded Cybercash, Barabone, seed investor in PayPal, seed investor in AOL. And we all kind of hatched this idea around, well, if everyone's distressed and everyone's having financial problems and liquidity issues, why don't we buy people out of their holdings? And so I spent about a year, doing all the BD work and meeting everybody in the market, trying to figure out how I could buy out people's investments. And that was really the start of Industry Ventures from an institutional perspective. And so if you look back, the firm was kind of refounded in like 2001, 2002, and kind of resurfaced out of the.
Where did you come up with the name, like Industry Ventures? Where did that name come from? Was that the early stage fund name, or was that A new name?
Yeah, I can credit Tom for that. You know, we all tried to figure out a good name for the business, and Tom had some foresight and looked at. We were looking for a website domain because that was kind of one of the criteria of just needing the website domain. And we also wanted to have something more generic that talked about, you know, the venture industry as a whole. And it ended up being a really good name for the business because we ended up over time going into the different venture segments of the venture business and building out the business over the last 25 years in kind of a category segment, kind of new product development way. And so the overarching name of Industry Ventures ended up being, you know, at the end of the day, a good one.
Yeah. So you
Yeah.
start out with early stage, pivoted to secondaries. You added new strategies over time, right?
We did. I'd say one of the things that's kind of a DNA of the firm, hallmark of the team here is just our entrepreneurial side. The whole firm has a really great entrepreneurial core here, and so we've been pivoting, kind of modifying, developing, you know, listening to the market, trying to figure out where the white spaces are, where we can compete, where we can build out, you know, fund strategies that are differentiated with outsized return potential the whole time. And so, you know, pivoting right out of the gate from doing seed investing and kind of angel investing into secondaries. You know, the next thing we did was, you know, after we built out the secondary business to a certain extent, we got into the small fund market and we bought one of our LPs businesses, Roland Reynolds, who's here as a partner running that team. And he's built out with the team here this whole partnership holdings business. So we have a secondary fund business. We have a partnership holdings business. That's the fund that's seeding new funds and, you know, buying LPs out of those funds. And then we added co-investing with those funds. So then we launched a direct fund business that did pro rata right investing, which is something you're doing. And then we launched a tech buyout business, which is the small end of the tech buyout market, trying to transition venture funded companies to tech buyout funds. We think there's a very long-term, you know, decade-long opportunity there. And we're very differentiated for sourcing and putting together the tech buyout funds with the venture funded companies due to our position in the market. So we started a business there about 5 years ago. So when you look at kind of the history of the firm, we've gone into different segments of the venture business. We've kind of modified our strategies. We've tweaked them over time. We've added things to them. It's been very fluid, and it's been based on what the market's needed. It's based on what the entrepreneurs need, what the, you know, management teams need, what the VCs need, and what the LPs need in terms of capital and help and solutions. And so now we've, you know, after 25 years of doing this and getting into various segments at different times as they've developed, we have a full stack firm that we're able to utilize all our information from the seed to the pre-IPO and tech buyout market as a team to help the market with not only liquidity but capital. So we do both primary and secondary investing today.
What do you think sets apart the best VCs? What characteristics do you look for generally when you're looking at VC partnerships?
You know, if you look at the small venture funds that we're funding, and we've funded some of the most successful ones in the history of the venture business, interestingly enough, they typically fall into three categories. If you could stereotype them or categorize them, I think, you know, the first one is it's an individual or two or three people that are at a brand name firm that's typically large, that love working together and they want to start their own business, right? And that they have a lot of experience, they have a lot of relationships, both with the entrepreneurs as well as with the other venture funds and people that focus on their sectors. A lot of times they're sector focused. And then they know some LPs because they were at a Battery or a Venrock or a Kleiner or, you know, Sequoia or whoever. And so they're spinning out, starting their own business. That's the first category. I would say in terms of new venture fund managers. That's kind of not the easiest category, but like the one that a lot of LPs focus on, just because they get to know the people when they're in these other businesses, like at NEA or something, and then they can, have a relationship and fund them when they spin out. The second category are people like you and I, which, we came from the entrepreneur side, the scrappy start your business to try to, be different and compete and have a new product and invent something. Those individuals typically are just like you or I, where they made some money from their last company, they had a success or two, and sometimes three or four, and they want to take their capital, invest it, and then bring LPs along for the ride. So that's the second category. We've been very active in funding those just because that's kind of where we came from. So we felt like we could understand that group of people better than most and relate to them. And then the third is someone who's got an amazing angel network. Maybe they came from Google or Facebook or somewhere like Microsoft or whoever, and they were doing angel investing while they were there or when they left. And they have this, a network of people that are spinning out of these hubs of, engineers. So if you look at the engineering talent around Silicon Valley, it moves around into different groups of, innovative companies. And specifically now you've got all these engineers retooling themselves to be AI engineers. But if you follow the engineers and you follow the talent, and you know who they are, and it helps to have worked with them before at one of these larger firms, and you can seed fund them. It's differentiated deal flow, and it's top talent. So we funded a group of folks that have been like that. So I would say those are the three main. There's others too, but I would say 80+% of the venture capitalists that are managing these seed funds or A round funds are in those buckets.
What would you say is the biggest surprise that you found at Industry Ventures in your career so far? What are the biggest surprises that you've had?
I would say I always thought that you could perfect this art, that it was something that's highly predictable. Now, there is a big component of investing in the venture business that's predictable, but there is also, over time, you get super humbled, especially if you've done 1,000 investments over 25 years.
Yeah.
How we trust. You get super humbled with the fact that there is a decent chunk of what we do and what you do and everybody else does that is unpredictable. So I would say the biggest surprise for me is just over time understanding and factoring that into our underwriting. And it's an art. I would definitely it's not a science. I'm not sure if it's quantifiable, because I've seen teams go and try to quantify that through data analytics and whatnot. But we'll see if AI can help figure that one out. But it's just a random walk. It's you are developing something different in a segment that everybody didn't think was interesting, and suddenly it becomes a $10 billion opportunity, right?
Yeah.
Due to platform shifts. A lot of it's platform shifts. So, like the iPhone comes out and there's this huge opportunity to create mobile games that are different because there's a gyro in the phone and a GPS chip in the phone. And so you can do all these different things with gaming, and the form factor is different, and then, blah, blah, blah. So a lot of it's platform shifts. We'll see that now with AI. I think it's another kind of replatforming, seems. And once these platform shifts happen, these like tectonic plates that move around, there's just an enormous amount of innovation that's unpredictable.
Yeah. I mean, I think we just did a podcast with Ed Sim at Bold Start, who OG, and
he's like us. He's been around for as long as we have.
Wait, you're still alive? You're still doing this?
Yeah. A couple months ago, I went over to his house in Miami and said hello and had a nice chat with him in his backyard.
He's crushing it. He's crushing it. He's just now finally getting some liquidity, but still, he's like, it takes 10, 15 years to grow an early stage business, which is painful.
Yeah.
I think that's probably my big.
We're lucky enough to be a small investor in his funds.
There you go.
Yeah.
That's fortunate. He's a great.
Wish we were a larger one than we are.
Yeah.
Well.
Yeah. He's crushed it every which way. But well, I bring him up because he was talking about how AI is a new vector for attack for cybersecurity.
Oh,
So
sure.
all of a sudden, you've got an explosion of cybersecurity companies that are both attacking using AI, but also defending using AI.
Yeah.
You and I talked about humanoid robotics, which is, talk about revolutionary. What happens to the 50% of global labor that's paid today if you all of a sudden an AI robot can do some of that or all of it? It's pretty remarkable. Where do you think you and I have talked over the years about where we are in different phases of the market? Where do you think we are today? Are we at an inflection point? Are we at a market lull? Are we where do you think we are?
I've been talking to a lot of our VCs that we've either bought part of their funds or funded with their new funds about this lately. And there's super high conviction in the market around the fact that we're like in inning one. I was with a team member from Khosla here sitting on our deck last week, and we're lucky enough to be an LP there too. And they called it inning zero. Because I was debating with them, hey, are we in the first inning, second inning? Like, where are we in this continuum? And they're like, no, it's zero. Like, it just started. Like,
you just got off the track.
We're in the anthem. So I was like, what? That feels like inning one or two to me. But
for what? For venture or for the industries they're looking at? Or?
Just the whole innovation cycle. We saw when the internet was developed, you and I were there when the internet started being used for consumer and business purposes. And, that was a whole cycle, right? A big boom and a bust. And then, these things cycle, right? So we might go through a huge boom here of funding and then kind of a pullback. And then we'll see the thing reaccelerate and do a 10 to 100x growth rate from there. Kind of the curve that these things go through. But so, internet was that. And then you had, cloud computing and mobile. Those are another two big platforms and kind of waves. Because when you move compute and apps, and not sitting on your desktop and they're, in the cloud, that allowed different things to happen, and you could use things in different ways. And then when you put things on the phone and made it mobile, right? That also, and now you've got a situation where all of these devices and all this hardware that's out there and all the platforms that were previously developed are all getting enabled with AI. And so, where it's going to go is kind of exciting. We're in this phase, I think, where everyone's developing a co-pilot. Because you need to interface with the models and with the AI so that it's human driven. It's kind of augmented human interaction, right, with computer and person. And then there's a thought that over time maybe just the human gets cut out of the loop, right? But a lot of what's being funded today are co-pilot businesses where it's like you've got the AI system co-piloting, right, with the human. And there's
done a couple of those this last quarter.
Yeah, I mean, there seems to be a lot of utility there, in terms of making us all more productive. But there is going to be maybe that's version 0, and where all this goes, kind of exciting. That's a little scary, some of it, but I would say it's pretty exciting. And I think we've got a huge 10, 20-year innovation cycle here again.
That's rocking.
Yeah.
Well, thanks, Hans. That's if just any last words of advice to GPs that are starting out 25 years ago. Is there anything that you wish you knew, I guess we talked a little bit about this, about the volatility of the sector and just the humbleness that, you got to have.
Yeah, the one thing that some people told me this, I didn't really listen. I've had, for better or worse, listening issues. But some people told us when I started out, they said, listen, there's only a certain number of LPs in the world that fund venture funds, especially new ones. There might be, couple hundred, max 1,000, right? That are LPs that consistently are
The
looking
fund new GPs?
at GPs.
You think there's 1,000 of them
Worldwide, probably, yeah.
at
I'd
scale?
I'd say at scale, probably not. But
Right.
in terms of new at scale lead LPs, I would say there's probably 25.
Right.
In terms of other LPs that are writing checks into these small funds, yeah, that's probably 1,000. And then in terms of consistent ones, it's probably a couple hundred. So it's not a ton. Like you can I tell everybody I meet, just start a CRM system, start with a spreadsheet, move to a CRM system, because you're going to be talking to all these LPs for the next 20 years, the same ones. So and they move around, right?
Right.
It's actually the thing I've thought that's been most interesting talking to venture capitalists over the last 25 years, just being an entrepreneur. They typically don't internalize the fact that they're just like the entrepreneurs presenting to venture capitalists. So if you look at the VC market, there's probably like 1,000 that matter, 200 that are kind of core, and then 25 that lead and dominate a lot of the activity. And on the LP side, it's similar. They think it's more fragmented than it is. If you're an entrepreneur and you go out and start raising venture capital, it looks super fragmented, right? There's like thousands of firms, and it's hard to figure out who's who and who might be a fit. And so, when VCs that are raising new funds go out to the LP market, they're kind of the same way. They think that, they think it's not like the VC market is with entrepreneurs, but it is. It's a mirror of it. So you've got the, VCs, and then you've got their LPs, right? And so I would say that's something that most VCs that start out or spin out or create their businesses don't really get, is that they're just like an entrepreneur going to pitch a venture fund. And, the capital bases, the activity level, the ability to lead rounds or lead funds, it's very, very similar. And I think once you've talked to them and they kind of get humbled by the fact that, now I'm in the entrepreneur's seat pitching, right, the LPs, which is just like the entrepreneur seat pitching the VCs, because the LPs that fund these small funds are the VCs of VCs.
Right. Yeah. Well, they have to take multiple bets.
That's what it is.
I see in the background, you've got a picture. What is that? A surf? Where is that surf picture?
Oh, that thing? Yeah, that's RingCon.
Where's that?
It's a big break. You don't see the whole thing. If you saw the whole thing, it's pretty big. It's down in Santa Barbara. And it's one of the surf breaks I really enjoy.
And I see you also have some skis in the back.
Yeah, I've got my old pair of skis that I used to ski on back here to remind me of skiing every day. But yeah, I should have a mountain bike in here too, and then I'd have all my.
How important to you? I mean, are they props in your life, or is work-life balance important to you?
Work-life balance is key. I would say I wish I've been working my whole career on work-life balance. And for me, without it, I don't think I'd be as good at my job. I think everyone needs great work-life balance, and it's a challenge, right? Because when you're building a business and growing a business or running a business, it's like all in. So I would say I felt like over time I've had to kind of carve time off for going on surf trips, going on ski trips, doing mountain biking, whatever. Yeah.
Have you seen that reflected in sort of the VCs and their success? Is it the ones who had more work-life balance or not really?
Well, I think I've seen both. The folks that don't have work-life balance, end up having a very one-sided life that is focused on work, right? So typically their family gets broken where, there's a fracture in their marriage
Right.
or their family, or they don't get married, and their kids. I think that to have a family life that's happy and healthy, you need to have work-life balance.
Years ago, you and I talked about, partners breaking up, and then,
Yeah, that happens all the time.
it's the biggest risk that LPs take when
Mhm.
investing in a fund is the partners breaking apart.
Yeah.
If you don't have that,
It's just like entrepreneurs, right? There's no difference.
right,
Now you've got two or three entrepreneurs and they start a business together. Maybe one's the leader of the pack and there's two others, or there's three that are all equal, or whatever it is. And then over time, as time clicks on, people change and their life goals change, and sometimes for the better, sometimes for the worse. And that affects both a business with its founding team as well as a venture fund with its, investors. So yeah, I mean, I've seen it help as well as hurt, because sometimes the founding teams, end up being dysfunctional and they need to make a change, and someone needs to take over, and the other people need to go. And or sometimes, they need to work through it and stick together. So it's the same thing on the venture fund side. Uh,
from your perspective, if that happens, is that like, are you going to wait to sort of see how things resolve, or are you out? Like for the next fund,
it's it's
are you like,
situation specific.
yeah,
You know, the hard one is the hard one to get your head around, which typically means you're walking, whether, whether it's the right decision or not, because sometimes it's the wrong decision to walk, honestly. The LPs make the same mistakes that VCs do. It's kind of funny. We sit on both sides of the table, right? It's because we make direct investments, do secondary investments, and we are an LP. And so we see it all from all sides. And, it's the same human mistakes, right? It's like, should have you funded the restart of Twitter? Should have you rolled your equity and wrote another check into Yammer when it spun out? A lot of these businesses, when they start in the venture business, they don't start as, you know, as that business. They end up, pivoting or restructuring. We're one of those, right? I mean, I started doing angel investing and I ended up building a secondary liquidity fund business, and then I mean, all these other funds that we've developed too have been pretty entrepreneurial. I think, venture funds are the same, right? They'll go fund an entrepreneur and a team, and then they'll go build something and it won't work, or it's the wrong time for it, or it's too early, or whatever it is. And then they retool it, and if they launch something else that they have learned is a better need for the market, that they've talked to the customers and they've retooled everything so that they can kind of solve a problem that's needed to be solved, and then the business cranks. And so, yeah, I mean, I think venture funds are no different. We've seen venture funds start and retool themselves and restructure, and people leave and other people join, and then they, either work or don't. I think the one that's really hard to get around, though, is when you have a founding team, they build a track record. A couple of the founding team members, after 10 years, leave. There's one, founding person left. That person decides to retire or leave. And there's this new group of people that don't have a track record, right? And then as an LP, you're looking at that going, wait. I'm giving the money to these people that actually don't have the track record, don't have the relationships, they don't have what the other team did. That's the hard one to get your head around from an LP perspective. But there's natural churn in all these partnerships. Every partnership, including the largest ones, have churn, right? Because people age out, their personal situation changes. They maybe for them a certain number, a certain amount of money was what their goal was, and they hit it, so they leave. And so there's other, personal problems that people have, or family issues, or whatever it is, and they go have to deal with it. And so there's a natural churn in the market, and very few firms have been able to kind of have a culture of entrepreneurship to fill in the gaps as the team that's managing the firm is churning. So that's kind of a weird talent among these venture funds. And I would say the ones that do it really well have core entrepreneurial talent to notice it, address it, put plans in place so that it doesn't become an issue.
I think managing that succession is really important.
Yeah.
And I'm sure something that you've thought about. But you've got another 20 years in you?
Yeah.
So what does the future have for industry?
We'll see. Feels like I have that much gas in the tank.
Well, I mean, if you keep the balance, I think you got this.
Yeah.
So thanks
See.
again for coming on the podcast. It's the dream come true for me to continue to be in this industry. I'm sure you feel the same way because you know how hard it is to build an enterprise, a startup or a venture fund, to scale and deliver value to LPs. You've built an impressive firm so far. Anytime I have a personal question about, or not personal or business question, you've been a great resource for me. And so I appreciate that. And I hope likewise for you as well. Thanks again, Hans.
Thank you, Steve. I mean, I'm saying something that's awesome in this industry is people like us that have been around for a long time that have a lot of history together. Seeing how what you've done has been also really impressive, and just trying to learn from each other has been great. So thanks for always reaching out and chatting.
Well, right. We'll do this again soon.
All right, man.
All right. Yep, thanks.
Thanks for listening to the Driving Alpha podcast, where we host top investors to demonstrate how they outperform the market. Click subscribe so you don't miss future episodes. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.